2025, January 21st. Overview of principal part of finance accounting. Financial accounting, well, for the first steps, what I'm going to talk about is financial accounting, of course, and financial accounting, there is very basic equation, which is asset first to liability plus equity. This is very basic asset we should remember. In asset, there is cash, account receivable, inventory, and buildings, so on. So if you go to trial balance, we write items below here, cash, account receivable. This is common assets. And if you go to liabilities, there's account payable, income tax payable, mortgage payable, and unearned revenue is liability. You should remember it. So if it increases, you should write it in credit. And if we go equity, there is capital stock, retained earnings. We will calculate a lot of retained earnings. I will let you know later. So for the financial statement, there is balance sheet, and there is statement of comprehensive income. There is statement of changes in equity, and there is statement of cash flow. Statement of cash flow is actually later related with engineering economy, which only regard cash flow and analyze the cash flow over time. Financial statement only shows certain point. The statement of cash flows only shows certain time of cash flows. And if you do engineering economy, then you can analyze the flows. So balance sheet, it comes every year. So there is balance sheet December of 31, 2024 balance sheet. Then there will be 2025 December 31st, there will be balance sheet. Then in the middle, there will be cash flow of 2025 cash flow, and there will be comprehensive income. Comprehensive income's result will go to net income of retained earning. Comprehensive income result will go to net income, and from net income, there is retained earning of last year's. You will do plus minus from retained earning of last year to net income, then there's new retained earning come out. It will be happening in statement of retained earning 2017, 2025. This is important. Statement of retained earning statement of 2025. You should remember the year. It will be complex later. So the new retained earning that we calculated will go to 2025 balance sheet. That's what we should remember. Statement of cash flow. The result is ending cash. Ending cash item will go to cash. This is retained earning. This is you should remember that cash and retained earning is different because from the first, we already discussed about accounting equation, asset, liability, and equity. The retained earning was equity. Retained earning was equity. And cash is asset. You should not forget it. It will make you confused if you not remember it. So remember it, and we will solve the problem later. So it will be also good for you in each statement how the plus and minus goes. Like statement of cash flow, it the net change in cash reflected and operating activities, investing activities, financing activities, cash, or if it is plus, it reflected as plus. The problem can come up like computing element of equity. That's all. And now we reach accounting cycle. If we go to accounting cycle, then in equity, we can divide it as capital stock and retained earning. Retained earning can be plus part of retained earning will be revenue. Minus part will be expense and dividend. Debit part, which means if it goes increase, then it will be written in debit part. Not payable is equity, so it will be right on credit part. It increase. We should remember this. This is also important. And like there's accounting cycle. When you do end of the recording, end of the accounting cycle, there is something that you should do because the difference comes from arrival and cash-based accounting. If you do accrual accounting, you should do adjusting entries. You should adjust entries such as unrecorded receivables or unrecorded liabilities or prepaid expense or unearned revenue. These things will be, you will write it first, like unearned revenue or prepaid expense. Let's say expense, it goes to debit part as expense because you already paid it. But later, expense will be removed and actual cash will go up. This is kind of how accrual accrual accounting goes on. Problem that may you can solve is see the post-closing trial balance, and you can adjust the account, such as there's prepaid advertising paid during 2017, includes 400, paid on December 1st, 2017. Then how should you balance the account? This could be good problem, you can solve it. And if we go to receivables, we will go specific to receivables at some point. If you go specific to receivables, there's some way how you can treat this receivable, like there's aging account receivable method or losses from uncollectible accounts. Then you can remove it day by day, so your asset could be removed. There's also note receivables. There's way how you can choose it, and there's inventory and the cost of sales. You should also record inventory, but there's various way you can record it because inventory cost can be changed. You should choose maximum one or minimum one, what to choose. There's cost formula, and there's also FIFO and weighted average cost formula exists. There's method of estimating inventories. And for liquidities, you should think about how to record depreciation. For depreciation, there's various methods. There is straight line method and unit production method. Straight line is just remove it samely, and depreciation method, there is very specific formula exists, very specific formula exists. So you can discard property, plant, and equipment. And there's how bond is paid. This will be good for you. Remove how bond is paid. Let's say there is bond 500 bond for 500 annually for 3 years. Then 100 years later, 3 years later, $10,000. Then the calculation will be like this. There's 9,733. Then you can also reversely you can calculate interest rate. If we multiply 1.06 of interest rate and minus 500, and if we do same thing, minus 500, if we do same thing, then it goes 100. So in this situation, you paid 9,733. Then who get the money, the person who receive money, their money will be increased. Then they will pay for you 500, and they will pay for you another 500 next time, and they will pay for you another 500. Then after that, they will pay for $10,000. This is how bond price work, fair bond price. You can calculate it in another way, which is you will get $10,500. So you can just divide it by 1 year of interest rate. Then you can also get $10,500. $10,500 is same as the money what you receive at 1 year later divided by for 1 year how you will receive. This is cash flow of 1st of January of 2024. And then for the interest rate, there is effective rate and so on. And for equity, there is common stock, preferred stock, and stock split will be topic. And for how we analyze stock price, there is three ways: equity method, FTV-PL method, and FTV-OCI method. By this, how you calculate the price is different. Some method will change the value when their stock price is changing, but for some method, they just analyze value when we sell the stock price. And for statement of cash flow, there is indirect method and direct method. There is indirect and direct method. Indirect and direct method for statement of cash flow. And we will analyze financial statement at definer. So there will be current ratio, which is ratio between current asset and liability. And there's other way we can analyze it. Maybe return on sale, asset turnover, return on equity, price earning ratio, and so on. This was the overview, and we will go one by one, solving the problems. And so, thank you very much.